the outset, I would like to extend my season's greetings to everyone. This is the monetary policy statement for the month of October, and this is how it goes. Kautilya, in his Arthasastra more than 2000 decades ago, had said, stability enables a state not only to share its wealth equitably, but also augment it. These words are relevant even today. In fact, they have eternal validity. Macroeconomic stability and inclusive growth are the fundamental principles underlying a country's progress. The policy mix that we have pursued during the recent years of multiple and unparalleled shocks has fostered macroeconomic and financial stability. The external sector also remains eminently manageable. The twin balance sheet stress that was encountered a decade ago has now been replaced by a twin balance sheet advantage with healthier balance sheets of both banks and corporates. India is poised to become the new growth engine of the world. The need of the hour is to remain vigilant and not give room to complacency. Lessons from the past 1.5 decades and from living through the global financial crisis and the taper tantrum tell us that risks and vulnerabilities can grow even at good times. All stakeholders in the economy, be it lenders, corporates, businesses, both small and big, and even policymakers should continue to reinforce their buffers and fundamentals in the fast changing world that we live in. So far as the Reserve Bank is concerned, we have identified high inflation as a major risk to macroeconomic stability and sustainable growth. Accordingly, our monetary policy remains resolutely focused on aligning inflation to the 4% target on a durable basis. Excuse me. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, that is the MPC. The MPC met on 4th, 5th, and 6th October 2023. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, it decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, and the bank rate remain at consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and bank rate at 6.7%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. Now, you may say that this is a status quo policy. Yes, to the extent that the rate and the stance remained unchanged, it is a status quo policy. But there are many aspects of the statement and our policy which I am going to now spell out, which will reflect, which will reveal and give an idea about our approach, not only to monetary policy, but also to various aspects of monetary policy as we move forward during this, amidst this global challenges and headwinds. I shall now briefly set out the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation has surged in July, driven by tomato and other vegetable prices. It corrected partly in August and is expected to see further easing in September on the back of moderation of these prices. A silver lining amidst all these is declining core inflation, that is CPI inflation excluding food and fuel. The overall inflation outlook, however, is clouded by uncertainties from the fall in Kharif sowing for certain key crops like pulses and oilseeds, lower reservoir levels, and volatile global food and energy prices. The MPC observed that the recurring incidence of large and overlapping food price shocks can impart generalization and persistence to headline inflation. Economic activity, on the other hand, has remained resilient. Taking into account the evolving inflation growth dynamics and the cumulative policy repo rate hike of 200 basis points, 250 basis points, which is still working through the economy, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The transmission of the 250 basis points increase in the policy repo rate to bank lending and deposit rates is still incomplete, and hence the MPC decided to remain focused on withdrawal of accommodation. The MPC remains highly alert and prepared to undertake timely policy measures as may be necessary in order to align inflation to the target and anchor inflation expectations. I would now like to provide an assessment of the growth and inflation scenario. To begin with, global growth. Let me turn to a detailed assessment of the growth and inflation dynamics, starting with the external environment. As I just mentioned, the global economy is slowing under the impact of tight financial conditions, protracted geopolitical tensions, and increasing geoeconomic fragmentation. Global trade is contracting. Headline inflation is easing but rules above the target in major economies. Headline, while major central banks are signaling a peaking of their rate hike cycle, there are indications that the tight monetary policy stance could persist for longer than anticipated earlier. Sovereign bond yields have firmed up, the US dollar has appreciated, and global equity markets have corrected. Coming to domestic growth, in contrast to global trends, domestic economic activity exhibits resilience on the back of strong demand, that is strong domestic demand. The momentum in agricultural activity in the second quarter of this financial year, that is 23-24, has been sustained, although the monsoon has been somewhat uneven. The acreage under Kharif crops as on September 29 was 0.2% above the last year's level. The industrial sector extended recovery in the second quarter. Manufacturing sector gained ground in July and August, supported by key sectors such as pharmaceuticals, basic metals, cement, motor vehicles, and food products and beverages. The Purchasing Managers Index, that is PMI for manufacturing, remained robust in September also. Services sector activity is maintaining buoyancy as indicated by healthy expansion in high frequency indicators in August and September. PMI services, the data of which was just released yesterday, has exhibited strong expansion in September. Construction activity continues to be strong. Investment activity maintained its momentum with good support from government capex. Private sector capex is gaining ground as suggested by expansion in production and imports of capital goods and new projects sanctioned by the banks. Capacity utilization in the manufacturing sector on a seasonally adjusted basis continued to trend up, which augurs well for investment activity. The total flow of resources to the commercial sector from banks and other sources taken together at rupees 10.6 lakh crore during the current financial year so far is higher than that of last year. Merchandise exports and non-oil, non-gold imports, however, contracted though at a moderated pace in August. Services exports expanded at a healthy pace. Now, what I have done is, I have given lot of data points in the footnote of my statement, and those of you who are interested may refer to the statement. So whatever statement, whatever I am saying here is backed up by, the data points which would justify the statements that I am making. So I would suggest that if there is interest, you may refer to the footnotes which are part of my statement. Now let me move on. On the demand side, steady expansion is seen in urban consumption, while rural demand is showing signs of revival. Looking ahead, domestic demand conditions are likely to benefit from sustained buoyancy in services, consumer and business optimism, government's continued thrust on capex, healthy balance sheets of banks and corporates, and supply chain normalization. Headwinds from geopolitical tensions and geoeconomic fragmentation, volatility in global financial markets, global economic slowdown, and uneven monsoon, however, pose risks to the outlook. Taking all these factors into consideration, real GDP growth for the current financial year, that is 2023-24, is projected at 6.5%, with Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. The risks are evenly balanced. Real GDP growth for the first quarter of next financial year, that is 24-25, is projected at 6.6%. Now, I said that economic activity continues to be resilient, and this is precisely what I was hinting at this is precisely what I was referring to when I said that please have a look at the footnotes. The data points will justify that statement, why we are saying that economic activity continues to be resilient and why we are projecting the current year GDP growth to be 6.5%. I would now like to focus on inflation. The heightened inflation levels in July and August at 7.4% and 6.8% respectively were largely driven by food price pressures. Vegetables, with a weight of around 6% in CPI basket, contributed to about one third of CPI headline inflation in July and to around one fourth of overall inflation in the month of August. Sustained inflationary pressures in cereals, pulses, and spices added to the overall food inflation. On the positive side, core inflation softened to 4.9% during July and August. It has eased by around 140 basis points, 140. It has eased by around, that is, core inflation has eased by around 140 basis points from its recent peak in January 2023. Further disinflation of the core component is critical for price stability. As evident from our survey, there is further progress on anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic. Now, this is a part of the surveys that which we have done, so let me repeat this sentence for better clarity. As evident from our survey, there is further progress in anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic, and the numbers are given in the footnote. While near-term inflation is expected to soften on the back of vegetable price correction, especially in tomatoes, and the reduction in LPG prices, the future trajectory will be conditioned by a number of factors. For Kharif crops, the area sown under pulses is below the level a year ago. Kharif onion production also needs to be watched closely. Demand-supply mismatches in spices are likely to keep these prices at elevated levels. The inflation trajectory will also be shaped by the El Nino conditions and global food and energy prices. In fact, global food and energy prices, if you see, over the last several months, they have been considerably volatile and they require careful monitoring, but that imparts further uncertainty to the inflation outlook. Taking into account all these factors, CPI inflation is projected at 5.4% 4%. That is same as what we had projected earlier. And if there are questions, we will explain it during the press conference that follows usually my statement. Now, taking into account these factors, CPI inflation is projected at 5.4% for 23-24, with second quarter, that is Q2, at 6.4%, Q3 at 5.6%, and Q4 at 5.2%. The risks are evenly balanced. CPI inflation for the first quarter of next financial year, that is 24-25, is projected at 5.2%. Now, what do these inflation and growth conditions mean for monetary policy? Let me try and answer. Over the last 1.5 years, monetary policy actions broadly included compression of excess liquidity in the system, increase in policy repo rate by 250 basis points, and change in policy stance to withdrawal of accommodation to keep inflation expectations anchored and break the stickiness of core inflation. Complementing these measures were proactive supply-side interventions by the government to improve domestic availability of key food items and reduce input costs. Consequently, headline inflation moderated to 4.6% in the first quarter of the current financial year, that is from April to April, May, and June of the current financial year 23-24, as compared to 7.3% in the first quarter of last year. So last year in the first quarter, it was 7.3%. This year in the first quarter, the headline inflation moderated to 4.6%. A significant easing of inflation pressures from its exceptionally high level in July and August is expected to materialize in September as the impact of fleeting food price shocks wane. Further, underlying inflation pressures are also moderating while the impact of past monetary policy actions is still unfolding. Even so, indications are that throughout much of the third quarter of the current financial year, food inflation pressures may not see much easing, or rather may not see sustained easing. External factors like energy prices and financial market conditions continue to be volatile. All these call for careful monitoring of the incoming data and the outlook. That is, we have to monitor not only the incoming data, but also the build-up of the future, the outlook, to clearly delineate the durable components of price shocks from its transitory elements. Monetary policy has to be in absolute readiness to take appropriate and timely action to prevent any spillovers from food and fuel price shocks to underlying inflation trends and risks to anchoring of inflation expectations. These are non-negotiable necessities. I would now like to turn to liquidity and financial market conditions. As I have reiterated several times in my previous policy statements, excessive liquidity can pose risks to both price and financial stability. To ensure that liquidity conditions evolve in sync with the monetary policy stance, the Reserve Bank, as a temporary measure, had imposed an incremental cash reserve ratio, that is ICRR, of 10%, which impounded about rupees 1.1 lakh crore from the banking system. The ICRR was reviewed on September 8th and is being discontinued in a phased manner ending October 7th, that is tomorrow. Moderation in excess liquidity conditions as a result of the combined impact of ICRR and advance tax outflows in September has resulted in greater recourse to marginal standing facility, that is MSF, by the banks. Elevated levels of MSF borrowings amidst substantial funds parked under the standing deposit facility is symptomatic of skewed liquidity distribution in the banking system. So what's happening is that a set of banks, they're depositing in the SDF every day more than 1 lakh crores. Sometimes it exceeds 1.5 lakh crores. At the same time, There are other banks which are borrowing from the marginal standing facility of the Reserve Bank of an equivalent amount. So obviously, the distribution of liquidity in the banking system is skewed. This got reflected in the firming up of weighted average call rate, that is WACR, which is the operating target of monetary policy. Despite such hardening at the short end of the term structure, the average term spread in G-SECs in the government securities market, that is 10-year minus 91-day T-bills, remained at around 40 basis points in August and September, suggesting stable financial conditions. In recent months, banks have preferred to place funds under the overnight SDF instead of offering them in the main 14-day variable rate reverse repo operations, that is VRRR operations. It is imperative that banks assess their actual liquidity requirements over the reserve maintenance cycle and bid accordingly in the auctions under the main 14-day VRR operations of the Reserve Bank. It is desirable that banks having surplus funds explore lending opportunities in the interbank call market rather than passively parking funds in the SDF at relatively less attractive rates. Greater volume of call money transactions would not only help in deepening the interbank money market, but also lower the recourse of deficit banks to the MSF. The release of the remaining impounded ICRR funds tomorrow, along with pickup in government spending, are expected to ease liquidity conditions. Festival time increase in currency demand may, of course, act as a counterbalancing factor. It's a turning pitch, and we will play our shots very carefully. Going forward, while remaining nimble, we may have to consider OMO sales, that is, open market sales of government securities, to manage liquidity consistent with the stance of monetary policy. The timing and quantum of such operations will depend on the evolving liquidity conditions. I would now like to touch upon financial stability. The Indian banking system continues to be resilient, backed by improved asset quality, stable credit growth, and robust earnings growth. The credit growth is broad based and backed by strong fundamentals of the financial institutions. The financial indicators of the non banking financial companies are also in line with that of the banking system as per the latest data available for June. Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The need of the hour is robust risk management and stronger underwriting standards. The global financial landscape is rapidly changing, and potential stress may emerge from unanticipated corners. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability. I would now like to touch upon the external sector. India's merchandise exports and imports have remained in contractionary zone so far during 23-24, although at a decelerated pace during July and August. Services exports grew at a healthy pace in the first quarter of this year and remained strong during July and August also, driven by software and business services. Inward remittances have risen by 5.8% year on year. The current account deficit for the first quarter of the current financial year 23-24 declined to 1.1% of GDP from a year ago. There was an accretion of US dollar 24.4 billion to foreign exchange reserves on balance of payments basis during the first quarter of this current financial year. On external financing, foreign portfolio investment, that is FPI flows, have seen a significant turnaround in 2023-24, with net FPI inflows at US dollar 20.3 billion up to September 23, up to September of this year, as against net outflow in the preceding 2 years. Net foreign direct investment, on the other hand, moderated to 5.8 billion US dollars in April to July from 17.3 billion dollars a year ago. The inflows under external commercial borrowings, that is ECBs, witnessed a turnaround with net inflows of 4.5 billion US dollars during April August this year, as against net outflows of 3.2 billion a year ago. The number and total amount of ECB agreements grew markedly during April to August this year, with about 60% of the total amount being raised for capital expenditure. External vulnerability indicators also indicate lower vulnerability in comparison with EME peers. India's foreign exchange reserves stood at 586.9 billion as on September 29 this year. We remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first one relates to prudential framework for income recognition, asset classification, and provisioning pertaining to advances, particularly in the context of projects under implementation. With a view to strengthen the extant regulatory framework governing project finance and to harmonize the instructions across all regulated entities, the existing prudential norms for projects under implementation have been reviewed. A comprehensive regulatory framework applicable for all regulated entities is now proposed to be issued. Detailed draft guidelines will be released for public comments. The next announcement relates to credit concentration norms, credit risk transfer, and this is in the context of the NBFCs. At present, under the large exposure framework, NBFCs in the upper layer are permitted to use credit risk mitigation instruments for reducing their exposures to a counterparty. With a view to harmonize the credit concentration norms among the NBFCs, it has been decided to also permit NBFCs in the middle and base layers to use the credit risk mitigation instruments for reducing their counterparty exposures under the credit concentration norms. The next announcement relates to gold loan bullet repayment scheme in respect of the urban cooperative banks, that is UCBs. It has been decided to increase the existing limit for gold loans under the bullet repayment scheme from rupees 2 lakh to rupees 4 lakh in respect of urban cooperative banks who have met the overall target and sub-targets under the priority sector lending as on 31st March 2023. This measure is in pursuance of our earlier announcement that suitable incentives shall be provided to the UCBs that have met the prescribed priority sector lending targets as on 31st March 2023. The next announcement relates to framework for recognition of self-regulatory organizations, that is SROs for regulated entities of the Reserve Bank. Self-regulatory organizations can play an important role in strengthening compliance culture among their members and also provide a consultative platform with the Reserve Bank for policy making. Therefore, it has been decided to issue a draft omnibus framework for recognizing the self-regulatory organizations, that is the SROs, for various categories of regulated entities of the Reserve Bank. And these draft guidelines will be issued for stakeholder comments. Additional sector-specific conditions may also be prescribed at the time of calling for applications. The next announcement is with regard to Payments Infrastructure Development Fund, that is PIDF, and we are extending this coverage of this scheme and including the Prime Minister's Vishwakarma scheme beneficiaries also. Since its launch in January 2021, the Payments Infrastructure Development Fund, that is the PIDF scheme, has enabled over 2.66 crore. I repeat, the PIDF scheme, since its launch in January 2021, has enabled over 2.66 crore new payment touch points across the country. It has been decided to extend the scheme by 2 years, that is up to December 31st, 2025. The coverage of the PIDF scheme is also being expanded, number one, to include the beneficiaries under the Prime Minister's Vishwakarma scheme, and number two, to deploy emerging modes of payment acceptance such as Soundbox and Aadhaar-enabled biometric payment acceptance devices. These measures will further accelerate the Reserve Bank's efforts to promote digital payments at the grassroots level. The next announcement relates to introduction of new channels for card on file tokenization, that is COFT. Given the growing acceptance and benefits of tokenization of card data, it is now proposed to introduce card on file tokenization creation facilities directly at the issue bank level. This measure will enhance convenience for cardholders to get tokens created and linked to their existing accounts with various e-commerce applications. And the final announcement is as follows, after which I will conclude. The last announcement relates to master direction on internal ombudsman mechanism in the regulated entities. You would have noticed that over the recent years, we have taken a number of measures to improve the system of customers' grievance redressal in the banks as well as in the NBFCs and other entities which are regulated by the Reserve Bank. Now, at present, we have also mandated, as you know, there is an integrated ombudsman scheme of the Reserve Bank. But before that, there is an internal ombudsman scheme in the regulated entities, be it NBFCs or banks. Now, at present, internal ombudsman framework in regulated entities comprises of separate guidelines for select scheduled commercial banks, non-bank issuers of prepaid instruments, NBFCs, and all credit information companies, that is CICs. These guidelines have similar design features but vary in certain operational aspects. It has been decided to effect certain changes and also consolidate and harmonize the internal ombudsman guidelines into a single master direction. This will further strengthen the customer grievance redress system of the regulated entities. Now, I am referring here to the internal ombudsman scheme, which every bank, every NBFC, every regulated entity is expected to have, and they do have it. We are further fine-tuning that system so that customer grievance redress mechanism improves further. Let me now conclude. The Indian economy is forging ahead in a challenging global environment, drawing strength from its underlying macroeconomic fundamentals and buffers. While growth remains on track, the declining trend in inflation was interrupted in July and August due to price shocks in certain food items. Volatile energy and food prices in the wake of lingering geopolitical tensions and adverse weather conditions render uncertainty to the inflation outlook. We remain vigilant of the evolving inflation dynamics. I would like to emphatically reiterate, let me repeat, I would like to emphatically reiterate that our inflation target is 4% and not 2 to 6%. Our aim is to align inflation to the target on a durable basis while supporting growth. Our commitment to ensure financial stability reinforces our emphasis on price stability and anchoring of inflation expectations. This would keep inflation risk premium low and improve our competitiveness, productivity, and growth potential. As we continue our journey ahead, we take inspiration from Mahatma Gandhi's profound words. And I quote, "If we keep that as our goal, we shall never despond, we shall never weaken, and we shall ever go forward." Thank you. Namaskar.